From the City of London for our audience worldwide, Bloomberg Real Yield starts right now. And we begin with a big issue. Investors confronting peak uncertainty.
All of these very binary events coming.
We need to get through U.S. elections.
Concerns about a contested presidential election.
The election is certainly driving the short-term volatility.
Add to that COVID infections are on the rise. The prospect of a resurgence of the virus.
We need to determine the stimulus.
The size and how broad its reach is going to be.
If we have a blue wave, we'll get lots of stimulus.
That can change the equation for growth expectations.
What we've learned is not to count Trump out.
Where we go from here,
until we get some good news,
will be dictated by the events of the next several weeks.
The next few weeks, the next few months don't sound good.
This economic recovery, again, is becoming choppy.
November is setting up to be a very hectic month.
There is a lot of anxiety. There are a lot of jitters.
There is a lot of uncertainty with regard to just the world in general.
Jim Bianco of Bianco Research joining us now. Jim, what a week in this market. This equity market breaking down again to close out the week by a little more than 1.5% on the S&P 500. But it's the absence of the bid in the bond market that I think gets the attention of both you and I and almost everybody else in this market. We're selling off. We're not driving yields lower. Yields are higher on a 10-year by 4 basis points to 0.86%. Jim, what's the signal you take away from that?
A worrisome signal. You're right. Remember that the Fed is doing QE. They're buying $120 billion of bonds a month. You've got the stock market flirting with a 10% correction. That's got all the hallmarks of a classic risk-off rally, that bond yields should be falling as treasuries catch a bid, as everybody rushes into their safety. None of that is happening right now. I think the takeaway is the market is still worried about uncertainty over next week's election, uncertainty over the rising coronavirus, and potential of more fiscal stimulus and or inflation. So all of that is more than offsetting a giant buy for the bonds from the Fed and what should be chasing people into it. Instead, they're looking at this news and selling it off. Should be very worried about that because it's not the way it should be working if everything was, quote, normal.
Well, Jim, everything's not normal right now, and that's the problem. This has been flagged well ahead of time. People were worried about this, that the traditional 60-40 portfolio was somehow broken, that you would not get those risk-mitigating characteristics from treasuries. Now, today's a single data point, but there's a trend there, Jim, and I wonder if you think it's going to continue.
I think it is. I think you're right. Today, the 60-40 portfolio is definitely not working, but it has been struggling to work for the last, several months in basically the reopening era that we've had. Interestingly, what has worked and has had a hard time people getting their arms around is gold. The correlation between gold, the negative correlation between gold and stock prices is at a multi-decade high right now. So we might be transitioning to something a little bit more basic as far as the safety hedge goes in gold. But with yields this low, with the prospects of higher rates, it's going to be hard to say that that 40 leg is going to save you should stocks continue to sell off.
Jim, intriguingly, for me, what's interesting is that actually elsewhere, this market has picked up on the scent of what's been going on. End of August, start of September, that's when crude topped out. That's when the dollar bottomed. That's when equities topped out as well. So away from treasuries, there's a story there, Jim, where you don't see a complete dislocation cross-asset. This market picked up on the scent of what could happen in Q4. Does that resonate with you, Jim?
Yeah, it does. It does, because what you started seeing in late August, early September was the cases that started to move higher in Europe. And then by late September, they started to move higher in the United States. The fear there was that that was going to lead to either shutdowns or people that were naturally afraid of the virus, like older or those of comorbidities, just voluntarily refraining from economic activity. That's really picked up in the last several days. The bond market has been difficult to read because, again, you've got the Fed with their thumb on the scale in that market, buying a lot and maybe distorting those signals. The further away you get away from it, the more these markets seem to make sense that they've been signaling that there's been a potential slowdown. Remember, the stock market peaked way back on September 2nd, at least the S&P 500 did. And that's kind of coincident with right at the bottom of the case counts as we started to move higher.
So, Jim, I think one of the most important questions in economics right now, regionally speaking, is China good, Europe bad, and the United States somewhere in between? And the question we've got to work through in the next month or so, I think it comes down to something really simple. Is Europe's present America's future? And how far away is that future, Jim? Walk me through your thinking on that question right now. I've asked it all week, and I'm getting answers either way.
Yeah, Europe did lead the U.S. in April, May, and June. It ran the cases up first. It ran down first as well, too. Europe appears to be leading the U.S. in this, quote, second wave since early September. It's been booming in terms of its cases, and now the U.S. is following. We had nearly 90,000 cases yesterday. The fear is that's going to lead to reactions by governments and reactions by people that are going to slow the economy. So, yes, I think Europe is a leading indicator. At least it has been the last couple of cycles when it comes to the virus. And the fear is that it will be again this time.
So do you think, Jim, you should be trading on the increase in COVID cases, selling risk, or trading on the course correction, the policies introduced to change course, and buy into this story, particularly in Europe as it emerges and markets break down?
Boy, that's a tough question right there, because we know that the cases are coming. We have been trading off of that for the last several weeks with the market lower. We also have the hope of a vaccine coming maybe by the end of the year or into the first quarter, or something that could give us some kind of relief from this lockdown, not lockdown cycle that we've been coming on as well, too. But right now, I think that the fear is there's so much uncertainty coming next week with the election, coming with the case counts in the United States. What is going to be the reaction function? Look, we printed 88,000 cases yesterday. If we print 100,000 cases or more in the next couple of weeks, what is going to be the reaction of state governments, governors, and people to those kind of numbers? Are they going to just say the death rate's down, no big deal? Or are they going to stop going to restaurants and pulling back? And I think that's what everybody's worried about, the latter, that they're going to stop going to restaurants, and they're going to pull back, and that's going to slow the economy. That's why I think the stock market is struggling right now.
Consumers disengaging. We saw that in Germany before the restrictions even came through. And I think that's the worry, the picture you're painting for the United States, Jim, especially with you sitting there in Chicago. Going into next week with the election, people have been asking this question now for months. If you wanted some downside protection, where do you go to get it at the moment? If you don't get it from the Treasury market, where do you go, Jim?
I think the best bet, well, first of all, it's a very difficult thing to find, because it's maybe it doesn't trade directly on the New York Stock Exchange floor, but it's probably going to be gold at this point. The thing that seems to get a bid when the market starts to struggle is gold more than treasuries. Remember that if the market sells off enough, that could be a catalyst for even bigger fiscal spending, and that could also retard any kind of rally on bonds on a supply concern as well, too. But gold is probably where you want to go, even though that hasn't been working for the last few weeks. If not that, there might not be an uncorrelated asset or uncorrelated play that everybody could look for, that this will work if we wind up with a contested election and spiking case counts and more talk of closing down again.
Jim, can you find it in the FX market? Typically, when things hit the fan, you go towards the dollar. Can you find it in foreign exchange? Yeah, I mean, that's been the typical thing. You saw that in March, too, that when everything did hit the fan, that the dollar did really rally quite a bit as well. The difference this time right now might be that we are in an era that we're expecting. We didn't expect the Fed response and the government response in March and April. We do expect it now, and that might not be as dollar bullish as everybody thinks it would be normally. So, yeah, it makes sense that you could see some kind of a dollar rally, but I wouldn't hang my head on that one too hard. Jim Bianco of Bianco Research. Jim, fantastic to catch up with you, sir, ahead of a massive week ahead. The Treasury market set up as follows: an equity market rout and a Treasury market that isn't getting a bid. Yields are higher by about 3 basis points today on a 10-year to 0.857%. On a 2-year note, we've been anchored there and hardly done anything through much of the year following the Fed. 15 basis points on a 2-year yield. Here's your week ahead. What a week ahead. What a final spread. Coming up over the next week, a slew of global economic data points crossing throughout the week, but investors really focusing on just 3 main events. Tuesday, it's the US election. Thursday, we get a Fed rate decision and Chairman Powell's news conference, delayed, of course, from Wednesday. And then finally, it's the payrolls report this coming Friday. From the City of London, for our audience worldwide, that does it for us. This is Bloomberg.